So, welcome to Master Your Money, where we discuss the most searched for personal finance queries. Today we are going to look at what is a pension lifetime allowance. Before we start, you might want to subscribe to the True Potential YouTube channel to keep you updated with all things investing and personal finance. All you need to do is click the subscribe button below, and if you press the notification bell, you'll also be notified when we release future videos in this series. I'm joined by David today, and we're looking forward to sharing with you the basics of pension lifetime allowances. Hello, David.
Hi, Esther.
It's one of the most searched for questions online, so in simple terms, what is a pension lifetime allowance?
The Pension Lifetime Allowance is exactly that, the limit of tax-privileged pension funds that a person can build during their lifetime. The standard lifetime allowance is currently £1,073,100 for the 2021 to 2022 tax year. It was announced in the 2021 budget that it will remain at the current level till 2025 to 2026 and won't be rising in line with the CPI rate of inflation.
Okay, so what happens if a person exceeds the pension lifetime allowance?
A lifetime allowance tax charge would apply if you exceeded the pension lifetime allowance, so it is worth speaking to a financial advisor if this is a concern. For some people, the pension lifetime allowance won't be an issue, but over a lifetime of investing and investment growth, you may find that you accumulate close to the allowance.
And how would I find out how much of the pension lifetime allowance I've used?
Speak to your pension provider, they'll be able to tell you. And if you're in more than one pension scheme, you must add up what you've used in all pension schemes you belong to. Remember, it's not a limit, you can save more. You only start paying extra tax when you take more than your allowance from your pension, not just when your pension pot reaches it.
Right, okay, so what is the lifetime allowance charge?
The tax charge only takes effect when you take your pension savings or when you reach age 75. The charge only applies the amount of money you take over the lifetime allowance. The charge you pay depends on the way you take the money out of your pension. Take the excess as pension income and the charge is 25%. You may also pay income tax on any taxable money you take. Take the excess as a lump sum and the charge is 55%, but you won't pay any income tax.
So it sounds like the kind of thing that I really need to speak to a financial advisor about.
Exactly. It is much better to get sound financial advice from a qualified expert when it comes to large sums of money and the tax implications involved with pensions. And everyone's circumstances and needs are different. So for something as important as retirement, it really is recommended to seek out a financial advisor. There's more detail to the pension lifetime allowance than will be specific to your set of circumstances. So get that expert advice on how to do more with your money.
The pension lifetime allowance is a limit on the amount of pension benefits that can be drawn from pension schemes, whether lump sums or retirement income. The lifetime allowance for the tax year 21-22 is £1,073,100, and it will remain at that current level until 2025-26 and won't be rising in line with the CPI rate of inflation. It may be the case that this doesn't affect some investors, but if your pension is approaching the lifetime allowance, then you should speak to a financial advisor. To learn more about personal finance, subscribe to the True Potential YouTube channel. Press the notification bell and you'll be notified when the next episode of Master Your Money is live. Thank you very much for watching.